Hey, how
James,
you doing?
I'm doing fantastic. How about you?
Doing good.
Awesome,
So,
awesome.
new agent, huh?
Yes.
When did you start?
I got licensed a little under 30 days ago.
All right. Been doing your research then.
Yeah, just at a point now, young. So my wife and I were 35. We have a 4-year-old, now making substantive more money, and just trying to figure out what to do with that. We've eliminated a ton of debt. So now we just have one student loan left. And we're in a season now where we're going to buy a house here. I don't know, whenever this market is, I don't just retarded, but you know that. But looking at understanding more about our money and making it work for us now that we've kind of started so late, so to speak.
Right on, right on. And now in the notes you had talked about policy design. What do you want to talk about today for this?
Yeah. So the IUL, I want to make sure I understand that thoroughly, because I think that's going to be one of the best vehicles for us now that we're 35, and then of course for our daughter who's 4, who has the time component for the interest to compound,
Mm-hmm.
and for her to do whatever she needs to do with that money. So I'm licensed with National Life, which is
Okay.
one of the examples you used, and you
Yep.
went through thoroughly with an example for your daughter. I think, yeah, and then for yourself it was like 6,000. And so comparing that to my 401k that I am maxing out with my employer, who offers a phenomenal match, but seeing that we ride the wave of the market, I want something that's more guaranteed.
Right.
And that's how I'm looking at the IUL.
Right. Yeah, I'm a big fan of utilizing both if you can.
Mm-hmm.
So do you have your 401k, is that through your wife's work, or you have a
No,
job that gets you 401k also?
through mine, yes.
Okay. And so they just pull right out of your paycheck then.
Mm-hmm.
For that. So you don't get the opportunity as an agent. So I'm self-employed as an agent.
Mm-hmm.
Do you just work straight for whatever company it is?
So I guess I'm non-captive, if that makes sense. So I went through OmniBay, if that makes sense.
Yeah.
Yeah.
And so who's doing the match? OmniBay is doing the match for you?
No. So I work for Google during the day.
Okay, that's what I was getting at.
Yeah, I'm sorry.
That's what I was trying to understand. Okay, so you have a Google, so your insurance stuff is like a new side business.
Correct.
Awesome. I like that. Okay, so I will show you how to do National Life. Is National Life the only one you're contracted with?
Like it's 6 of them. But when I saw your video and you picked up on National Life, I was like, "Ooh, let me dive into their back office system." Because
So which carriers are you contracted with?
Transamerica, National Life, Great Western. That's Great Western, American National, and there's one more that I think is pending, and I think that's Nationwide.
Nationwide. Okay. So of those, probably the best, National Life, probably the best one of the bunch. Transamerica and Nationwide both have pretty good IUL products. They limit, the recent changes that they've implemented limit your ability to fiddle with the design and make it more optimized, creating more cash value right out of the gate for clients. So it's going to depend on what the client's needs are as far as early liquidity. Everything I try and do is designed with early liquidity in mind. And to get that early liquidity, the agent has to cut their commission. That's the only way to get early liquidity. Okay, a traditional design is just all base face amount, and the agent gets paid good money, but that leads to almost no cash value or no cash value in the first couple of years, and high surrender charges for a number of years. Okay, I don't like those designs. Everything that I do is about helping people maximize their cash flow, and losing liquidity to large amounts of money, because I work with people, we talk about ways that we can put lots of money into these things, So, and to each person, lots can mean different things, right? To some people, lots could be 6,000 a year. I have somebody that's doing 100,000 a year. So regardless of the amount, it's my intention that they have as much access to that as possible with as little penalties as possible. If for some reason something happens, emergencies happen, financial catastrophes happen, the economy can crash, you know, things change, things that people may not expect when they sign up for a policy. So I don't want people signing up for a policy to put in thousands of dollars a year, and then something happens, they have to close it or whatever, and they just lose it all. You know, and so it's something bad on top of whatever else is already bad going on in their life. You know, that makes for a narrative that they are willing to share with everybody, that that was the worst thing I've ever done. I should have never bought that product. It cost me all of this money. I didn't get to use any of it. You know, never do that. That's what they tell their friends and family when that happens, right? Well, on the flip side, if we design the policy the way I like to design it, where they have a lot of cash value, those penalties are minimized, and they have access to that cash right away. If something happens, now the policy can serve to save them in that situation. They have an asset they can go to get money and hopefully get them through this. And now that conversation will change in the future. And it becomes, that was the best move I ever made. I recommend everybody should get one of these things. It saved my bacon, you know? So that's why I do what I do. That's why I design it this way. It's not because it pays great. It doesn't pay very great, especially with National Life. Some of the National Life ones, like I just did a couple of kid policies with National Life where I got paid like $80 because of how I do the split design. That's not very much, you know, but I did a family of 7. So I got a couple of thousand from the parents. I get, you know, 7 or basically a few $100 among a handful of the kids, and some of the kids are a little more. So, so it all ends up working out well together. Okay. This year, even designing it this way, where I try and minimize my commission for everything, I'm going to make about $400,000 this year.
Awesome.
So I'm pretty happy with that.
Okay,
you know? Everybody should, right?
Yeah.
It's good compensation, even though I am minimizing the amount that I'm going to make on these things. And that's because people understand. I'm very transparent when I share with them the designs, why we designed it this way, how it benefits them, not just immediately, but in case of emergencies, right? So that's my approach to doing insurance. I mostly sell Allianz because that's, in my opinion, the best carrier out there. Okay. So if you can get contracted with Allianz through your company, then great. If you can't, you're welcome to join my team. You can get contracted through Allianz through me and still stay with those folks for all the other carriers if you'd like. Okay. We do basically start off at 90% of target premium for commission. So okay.
At the end of the call, I would like to do that.
Okay.
I can tell you that for sure.
Okay, I'll send you over the contact info. Okay. It's pretty easy. It's pretty easy to get set up. So, so anyways, I'm just starting to build my team. We've got about a dozen folks. I'm going to start doing webinars with folks so they can learn how to do the designs, and basically I can answer any questions and help people to build their business. I'm transitioning to that being more of my focus, because like I love helping people, but I'm only one person. And like when I do all my business by making videos for YouTube. I don't pay for any marketing. I don't buy any leads. So all that money that I've made this year is just from income brought in from my YouTube videos and clients.
Clearly we're here.
It's awesome. Yeah, it works great. So the problem is like when I'm doing videos, which is like what I like to do because it gets more information out to people and it helps with that transparency, I end up getting overwhelmed with clients. And like, I can't serve as many clients as I need to in order to get everybody educated on these products. So that's why I want to work on building a team, because then we can basically tackle and help a lot more people. There's going to be a lot less people buying these crappy designed products that put them in a bad situation. So, okay, so let me show you since this was what you signed up for, let me show you National Life. I'm going to share my screen with you, and we'll go through a design on that. And I can email you this video afterward too.
Okay.
Or I think I can give you the ability to record if you'd just like to record.
The link is fine.
Okay, we'll do it that way then. It'll take a little bit because it's got to process, and then I'll upload it as an unlisted video on YouTube. So,
okay.
Okay, so National Life. We go to illustrations. And when you get connected with me for Allianz, I have an Allianz one recorded that I'll share with you.
Okay.
So let's do a new illustration. You're in Tennessee?
Tennessee. Mm-hmm.
So we got a number of choices to choose from. Basically, the Flex Life is the typical one. If it's a high dollar policy that you're going to do, you could do Peak Life. Peak Life requires over $1 million. Okay. It's got better bonuses. That's basically why you would want to use Peak Life as opposed to the other one. Oh, I clicked on it.
Question, and I'm going to ask you a lot of the hows and the whys. So on my enrollment information, it gave me LSW, and then you just selected LNL. What's the difference?
It's the same.
Okay.
National Life owns Life Insurance Company of the Southwest. It's just another name that they sell products under. So either one, it's exactly the same.
Okay, thank you.
So we'll put your information in here. What's your birthday?
7/3/86.
And what kind of health rating do you think you might qualify for?
They came back at, it wasn't elite, it was select or preferred non-tobacco.
Okay. So you've already started applying for yours?
So yeah, I did. So I currently have a term policy through AIG that I got when my daughter was born. And then I basically just mirrored that for a term. I didn't do the IUL.
Okay, so you just got term with National Life?
No. I did a quote for it. It was more expensive.
Oh, just a quote.
Yeah.
Okay. But they gave you a health rating?
Yes.
Huh.
I went through the whole process on myself. Okay. So I know from beginning to end.
Gotcha. Okay. But you were just doing that to understand the process. You're not buying the term. Gotcha. Okay, that makes sense. You'll still be able to use the same health rating if you apply for the IUL. So the health exams or offers like that, if they did an actual exam, those are usually good for like 6 months. So depends on the carrier. So here we have our face amount. Okay. Well, first let's start up here. You got guideline premium test, cash value accumulation test. The guideline premium test is the one I always use. Cash value accumulation test, some people like to use those. It allows you to stuff a little more money in the first few years. I tend to see that for people that are designing like 5 pays with an IUL, where people want to just put a chunk of cash in and then stop. I still don't like to use the cash value accumulation test even for that. And part of that reason is because of how I design things. It minimizes that commission. Under the cash value accumulation test, well, under both of these, since you have to have the cash value accumulation test would allow you to have a lower death benefit, slightly lower death benefit out of the gate in order to have a higher MEC limit. Okay. And because they're only funding it for 5 years, it works. If you're going to fund it for longer than that, it doesn't work for a design. Okay. But that higher death benefit, you have to keep it around the whole time. Like you have to keep a higher death benefit throughout the life of the policy. So we can reduce the death benefit down the road, but not as much as we can reduce the death benefit with the guideline premium test. Okay. And with these policies, if you saw my part 4 of my IULs, where I talk about high early, high late cost policies, and then low early, low late. Well, the cash value accumulation will lead to a higher late cost. Gotcha. And those costs at the end make a big difference, much bigger than the costs at the beginning. Okay. So I would rather go with the guideline premium test, even if it's not optimal for the first few years, as far as putting money into it, because down the road, we're going to be able to have the costs be so much lower than this one. And as it turns out, the guideline premium test is actually better throughout the life of it. And that's because of how we design it. Because I minimized that commission and I reduced the commissionable term insurance that we blend in with this, that extra death benefit that you're paying for is very minimal between these two. Okay. So even though we have to have a little higher death benefit on the guideline premium test, you're still better off. Next thing we have to do is you can choose a solve. I never use the solve. These solves do not optimize a policy because they don't blend at all. So if you click on minimum death benefit, maximum cash value, oh, look at that. I can't put anything in this box. Well, this face amount, all the death benefit in this face amount is what determines the agent commission. Any death benefit you put in this additional protection benefit box doesn't pay a commission. And National Life allows you to do a 3-to-1 split. So that means if you have 100,000 in this side, you can do 300,000 over here. And why do I have an error? Oh, it's because of the product I'm using. We need to switch back to the other product. Well, it doesn't really matter. It's still the same design. I just have to have a bigger one here. So I can't show you. This one's going to be a lot higher than, this will be a really high mech limit. Okay. Probably a lot higher than what you're looking at contributing. So over here, if we look on the left-hand side, this is for a level death benefit, 250,000 base, 750 additional. Well, you can see our mech limit for the max non-mech, 63,000. This is how much you would be able to put in for the first few years, but then it's going to drop down because your average over the life of the policy has to average the guideline level or less. Okay. So when we're looking at designing a policy, if you're doing a level death benefit, your mech limit is effectively 16,600 for this $1 million in death benefit. So the first thing we do is we go to an increasing death benefit. And what you'll see is same death benefit, $1 million, but now the client can put in 47,000 a year. Okay. The max non-mech stays the same. So it doesn't matter if you're only funding it for a few years, you could follow the max non-mech. Okay, but if you're funding it longer than that, the guideline level is going to be what you need to worry about. Now, target premium. Do you know what target premium means?
So that's the most they can put in for the year.
No. That's what mech is. That's what your guideline level is.
Oh, okay. Then no.
Did they train you what target premium is?
No.
Did they tell you anything about target premium? Typically, a lot of carriers, like some places will give agents points based on target premium. And they'll have a target that they want you to reach as far as how much target premium you sell. They traditionally will teach you how to design a policy based around target premium. So if a client says, oh, I want to put 6,000 a year into a policy, well, they try and make that the target. Because what it sounds like when you're trying to reach a goal, you usually aim for a target, right? Well, this is a misnomer. Target premium essentially just tells us what commission is going to get paid out. All the commissions are based on target premium. An agent typically makes 90 to 100% of target premium. Depends on who they go through. If you go work for a multi-level marketing organization, they might start you out at 30% of target premium because everything else above that's going to the upline. Okay. But that's essentially what target premium is. So in this design, when I split this up and I do 250 and 750 here, my commission is going to be about 2,500 bucks. Okay. Well, if we didn't do this, if we didn't do this split, and we just did $1 million right here. Nope. Look at that. My commission is $10,000.
Gotcha.
That's a big difference.
A huge difference.
So let's see how much we're going to pay into here. Let's say we pay in, we've got our guideline level here. So let's say we pay in 48,000 for the year. 48,000 a year going in. So under this one that pays out a big commission, you can see we do have some surrender value in here. We got 24,000. So we got about half. Now with National Life, it's not accessible in the first year. You don't get any loans in the first year. But after that, you can start to get loans. Okay. So this isn't so bad as far as cash value goes. And a lot of that's because we did that increasing death benefit. But essentially your surrender charge is almost $20,000 that first year. And in the second year, it's still $17,000. And in the third year, $15,000. And in the fourth year, $14,000. So like it goes down, but it goes down slowly. Right. Now on the flip side, what happens when we split this up? Reduce that agent commission to the maximum amount. And well, it turns out I can't quite put 48,000 in because it drops down, that guideline level drops down. But you can see I could put it in for the first 5 years. That's because that non-MEC is higher. But they're still better off because look at this, 39,000 cash value that first year. So essentially the surrender charge is only $5,000. And in the second year, 5,000, third year, 4,000, fourth year, just over 3,000. So much, much lower surrender charges. So if something happens, this is why I talk about liquidity. This makes a big difference when it comes to liquidity. Okay. Now there's different ways that people can get the liquidity. One is this way. And typically when we design it this way, this works out great for the clients. Like most clients, if they think like they might want access to the cash value, they don't need access to every single dollar. You know, they're okay with having 5,000 less in the first year or two. Okay. But if we go to, if they did want access to every single dollar, there's a rider you can use. It just costs a little bit of money. It's called the balance sheet benefit rider. And when we put that in, now you can see there's no surrender charges. So we got access to every dollar. The only problem is it costs money for that rider. So if for some reason your client wants access to every single dollar, you can add that balance sheet benefit rider. With how we design it right now, the cost of that is very minimal. If you designed it with the really high commission and you add that balance sheet benefit rider, the cost of that rider is going to be a lot more substantial. Okay, but it's one way that agents could fool a client into thinking they're designing a better policy by giving them a lot of cash value, even though the way that they did that is by having them pay a lot more by using that balance sheet benefit rider. Okay. Now, the only time I've used a rider like that is with a real estate investor who wants access to every single dollar possible. Because when they have access to every dollar, they can make more money with that than that rider would cost them. Okay. So that was their reason for using it. For the most part, I think I've only used it once. and that was, and it wasn't even the balance sheet benefit rider. It was, it's called something else, and it's on with Allianz. Allianz has something similar. It's called the enhanced liquidity rider. Okay. So that's that. Most part, we don't use it. So no, I typically don't add any extra riders into these things. Okay. The key to the design, and this is what I like to tell clients, is any death benefit we put into this box pays out a commission. Any death benefit in this box does not. So that underlying cost of adding this insurance is very inexpensive. So you can build up a very high mech limit, or at least higher than what they're expecting to do. You could build in some extra space for a very low cost. So like if you said, oh, you want to put in 6,000 a year, but you might make more money in a couple of years and you might want to increase that, well, then we don't want to set the mech limit right at 6,000. If you think you might want to increase it, we can actually build that in right out of the gate by adding extra death benefit here so that you can contribute more down the road. Okay. All of that mech space, if you don't use it, it carries over. So you can use it the next year. If your mech limit is 8,000, you put in 6,000 this year, you can put in 10,000 the next year. So the full 8 plus the 2 that you missed. Okay. And that'll carry over forever unless you make a change in the policy. If you ever make a change in the policy, you reduce the death benefit, it'll reset the mech limits.
Okay. So if they, in that example, if the mech limit is 10, they do 8, they have 2 left over, and then they can put 10 the next year. If they come up to the mech limit, does it then go away?
What do you mean?
The mech limit is 8, right? And they put in 6, so that you're carrying over $2,000, and you can put up to 10 the following year.
Right. Then it's back to 8 the next year.
Okay. Okay. Gotcha.
Yeah. Basically, the way to look at it is if the mech limit's 8, then by year 10, you will have had the ability to put in $80,000. Anything less than that, you could catch up all the way up to that 80,000.
Gotcha.
Okay. All right. So that's increasing death benefit. This is how we split it up. Not every carrier allows you to do this. Nationwide used to give us the ability. They don't anymore. Mutual of Omaha gives us some ability to do the split, but they penalize the client if we do the split. So it doesn't actually help to do the split with them. Meaning when you do the split with them, they reduce the mech limit.
Wow. Okay.
Yeah, it's kind of shitty. North American took away the ability for us to split it. So North American and Midland, they don't offer the ability to do a reduction here either. National Life 3-to-1. Securian gives us the ability to do a 4-to-1 split. Allianz, it's between 5-to-1 and 10-to-1 that they will allow for a split. Yeah, that's why Allianz is my top carrier. Now, Allianz does have a $100,000 minimum for the commissionable term amount. National Life, and this is why I used it for those kids in that other one the other day, even though it paid me a pittance. Allianz allows National Life allows 100,000 total between the two, not in this product, but in the Flex Life. So in Flex Life, I could do 25,000 in the base space and 75,000 in the additional. So that's why it paid a very low commission, but it actually worked out really good for the level that they were planning on funding it at. It was the only one that really made sense. Okay. So that's why we did that one. Next thing to consider is how long you're going to pay into it. I like to treat these as retirement vehicles. Just plan on paying into it until you retire, because there's a cost of insurance every single year, whether you decide to pay it or not. So if you just pay it, then you don't have to worry about those costs coming out of the cash value. Right? You're giving that cash value the best opportunity to grow. And the reason you might want to do that is because you know that it's downside protected if the market crashes. Okay. So I always just hit the mech limit every single year. My plan is to do it every single year until I retire. Once you retire and you want to start pulling money out of these things, we're going to do so with a plan to not ever pay those loans back. Right. So I usually will illustrate payments through age 64. Well, 65 here on National Life's. On Allianz, you got to put 64 because it accounts for it a little bit differently. If we look at this and we stop paying that at age 65, We're not going to be able to see it in here. This one doesn't have the costs. Basically, let's take a look at the cash value down the road. So this will give us an idea. So cash value down the road by age 90, we got 18 million, almost 19 million in here. Okay. This is a high dollar amount. This is 48,000 a year. Okay, for 31 years. Okay, but that's a nice return. 18 million, almost 19 million bucks. This is $1 million in death benefits still. You can see the difference between these two over here. This is our death benefit on the right. This is our cash value. The difference is $1 million bucks because we still have that increasing death benefit, even though we stopped putting money in here. As soon as you stop putting money in, you don't need that MEC limit to be the same, to be as high anymore. Okay, so we can reduce that death benefit. We don't need to keep that $1 million bucks. That $1 million bucks is actually very expensive. When you get here to age 90, that annual renewable term, the cost of it is based on what's the likelihood you're going to die this year. Well, at age 90, that's pretty high statistically.
Yeah.
So the cost of that insurance is probably $100,000 at age 90. Okay. By the time you get to age 93, it's probably $200,000. You know, so you're going to have that, you're going to pay over $1 million bucks over the course of just a handful of years here when you're older, just to get that, just to keep that $1 million death benefit. So what I usually will talk to clients about is, you don't really need that. Like, you've got plenty of cash value at this point. There's no reason to have those expenses so big. There's a breaking point in here. So what we try and do is right after they decide they want to stop paying, that's when we can start to reduce that death benefit and bring those costs down.
Okay.
And if we do that, after about 20 years, we're going to have more cash value than we did even death benefit in this scenario because of saving on those costs. However, if they pass away within those first 20 years, they probably would have been better off keeping that death benefit up. So what I tell clients is we want to sit down when it comes to that point and have an honest conversation about what your life expectancy is. How do you feel? What do you think? If you got more than 20 years in you, let's maximize that cash growth, reduce these costs. If you don't, probably better off sticking with the high death benefit. Okay, so let's see what happens when we reduce these costs. So age 90, 19 million, essentially 18,975. Okay, so what we do to reduce the costs is we change it from an increasing to a level death benefit, and we're going to do that same year. And we're also going to institute a maximum face amount reduction. So if we do that, what happens here is the distance between these two changes. You can see right here, it's $1 million bucks. Well, right here, it's only 930,000. No, 830,000. That's going to continue to get lower and lower, at least as low as it will let us. So right here, we're at 500,000 difference. Okay. Well, by the time we get to age 90, well, look at that. We got an extra $500,000, $550,000 in there because we reduced the cost. And the distance between these two, oh, look at that. It's back to $1 million bucks.
Back to $1 million.
We still have the $1 million bucks. That's because the MEC limits require it. So at this point, when we reduce it, it's only going to have as much as is required. There's called a corridor of insurance. The insurance company is required to have a certain amount at risk. Okay. But you saw up here, it came down to about 500,000. Well, it was 400,000 right here. A little bit less than 400,000. And then it climbed back up because it had to. So the cost of your insurance, what you're paying for cost, is the difference between these two numbers. Okay. And we always want that as low as possible. So you can see we're up over 500,000 here compared to what it was before. And we still have that extra $1 million bucks. So that's a pretty good deal. That ends up turning out to be a pretty good deal. But it also leads to, if somebody wants to look at this as an income stream, it allows them to draw out a lot more money for an income stream. So let's go back here. We'll design an income stream. Distribution, solve for income. And we do it with loans. And we're going to go age 66. So there we go. Potential payout is going to be, yeah, right there, annual income, $360,000 a year for potential income. If we go back and we don't make this reduction, instead of 360, what does that give us? 289. Huge, huge difference in potential income.
Big difference.
Yep. So the optimal design policy is going to show people how to reduce those costs in the future. It does not happen automatically. Okay. So any changes to the death benefit, they have to institute it. Meaning if they decide to stop funding it sooner than age 65, they're welcome to, and they can make that change at that point to reduce that death benefit and start to bring those costs down. If they want to keep paying it when they get to 65, they can do that. They just don't need to make any changes. Okay. It's only once they make a change that they're allowed to change the death benefit. Once they stop funding it, they're allowed to change that death benefit and reduce that cost because you don't need that MEC limit anymore. Otherwise, this policy it's streamlined and designed to be able to allow them to put in $48,000 a year for as long as they want. Okay. Although in actuality, 47,318.
Because the guideline level. Okay.
Yeah, guideline level. Any questions?
No, you got it.
Right. I think that gives you a pretty good understanding of National Life. So you got your interest rates over here. You can see here the bonus on it, 0.9%. That's because it's the peak life. Under the flex life, it's 0.7. Okay, and this is an uncapped option, which is nice. I like the uncapped options. When I bought my National Life, they didn't give me an uncapped option. They didn't have that available. And they still haven't made it available. Like they haven't changed what's available to me. Wow. So one of the downsides to National Life is they'll make changes to products in the future and they will not
retroactive.
Yeah, they won't make them retroactive.
Okay.
So they're kind of one thing I saw about they have another plan that back in 2008 when this one started, it was paying out. The cap on it was like 12%. Was net for their S&P. Their cap this year is like 6.75.
Wow.
Yeah, it sucks. So, and if you look at it, it looks like they've been reducing it year after year after year. So I'm hoping they don't do that with mine. They have been so far, but my cap is at 9.75. I'm pretty happy with it still because my average is up around, it's still right around there. Yeah, my average is just over that, I think, for my return because I've been hitting the cap every year. But if they're going to reduce my ability to do that, that's when you want to start considering that 1035 exchange, where you can just transfer all of your cash value into a new product. You got to start over with the expenses and stuff, but at least you're not subject to a policy that is actively limiting your potential gains.
Okay.
I don't know why they've gone that low on that particular product. I wasn't around selling that product. So they might have a reason for it that hopefully they will not do with these other ones. But I kind of worry about that with any carrier that offers a whole bunch of different IULs that are kind of all targeted at different people. Mm-hmm. Like that's a carrier that likes to, dig into the fine print and optimize everywhere they can, possibly at your expense. I'm hopeful that's not going to be the case here, but it could be. So something to consider. The thing I like about Allianz is they only have one product. They have one IUL. It works great for everybody, unless you're putting in such a small amount that we can't do any type of a blend because we have to have that $100,000 minimum. Okay. But if they make a change on it, it affects everybody. Mm-hmm. So, I appreciate that. there's this systemic allocation option. What that does is when you make a premium payment, it'll spread out that payment over the course of 12 months. So you end up with 12 different crediting periods. It's kind of like dollar cost averaging. So I like to use it for that purpose. Otherwise, if you put the same amount of money in at the beginning of each anniversary year, by the time 30 years down the road, you're going to have one big crediting period. And whether you make money that year is going to depend on whether that particular crediting period is up or down.
Okay.
With 12 different ones, pretty good chance you can make some money every single year.
Mm-hmm.
Okay, so it'll even out the ups and the downs. Like that's how I view it. So I do like to use that, typically recommend it.
And then you can just make that selection here at this screen.
Yeah, you can check that here and it'll carry over to the application. Because when you hit this, to submit it to eApp, it'll pull the information from your illustration. Okay.
Okay.
That's about it. When you go to reports, I always include every report. That way they get all of the policy charges, internal rate of return. All of those things are good, important things that clients should know about. Okay.
I agree.
And that's about it. I think I've basically covered all the design there. And we're a little bit past time, but that's all good.
I appreciate you, James.
Yeah, no problem. Any other questions then before we wrap this up?
No, thank you. You hit everything. I got a lot of notes to take. I'm definitely going to replay this probably 10 more times.
Right on.
And be reaching back out to you.
Well, let me email you John's information.
Okay.
So John Encinas is my contract at True Choice Financial. Okay. That's my IMO. So just like yours is, what did you call it?
OmniBay.
OmniBay. There you go. So they have no issues with you being contracted with anybody else outside of it. Like I'm contracted through True Choice with probably like 10 or 12 different carriers. I'm contracted through another one for a couple of other carriers. I'm contracted through somebody else for Guardian and Mass Mutual. I'm contracted through Penn Mutual directly. So if you want to get connected with Mass Mutual and Guardian, I can also connect you with that too. You can get a contract for them.
I'll grow into that.
Just let me know. There's always, so whole life and IUL kind of, there's a good place for both of them in people's portfolio. I'm a fan of both. I own both. They serve different purposes. So, but yeah, get comfortable with whatever you're doing first. And when you end up coming across something, like you'll keep doing your research and you'll hear good things and you'll hear bad things. And basically, if it's optimally designed, like how I do the IUL, the whole life is great. If it's poorly designed, they're terrible. I don't like them. So all of the complaints are justified. Same thing with the IUL. You got people that complain about the IULs. That's totally justified if it's the traditional design. The way we design it, these things are awesome. So, so if you ever find I think that might be an option, you can look at expanding at that point. So.
I've made a few posts to my social media on Instagram to my close friends, and I forgot that one of my friends, he's in wholesale real estate, and he was asking me what are the policy limits, because right now he's putting 50 to 60K into a couple of different policies, but his guy is in Pennsylvania. And I was like, let me get more information about that. And I definitely want to, be able to assist you, because I do some other work from him aside from that. And so yeah,
who's this guy in Pennsylvania? It's probably,
I don't know. I didn't get the name.
Oh, okay. So Steve Parisi is out of Pennsylvania. He's at IBC Global, and that's who trained me. That's my mentor. So
okay,
could be him. He works with a lot of real estate folks, but we work with people across the country too. So
cool.
But yeah, definitely a good opportunity out there. So contact info for contracting.
And to your point, there is a product for everyone. One of my wife's college friends reached out to me as well because he was recently, or in 2019, he was denied coverage because he has hyperthyroidism.
Mm-hmm.
And it was my belief that the agent just didn't want to work with him because in all the underwriting that I've seen, and I have his prescription and the milligrams, he should be eligible for coverage. He's 35 like we are. And I was like, that doesn't make any sense. So let me do some digging.
Yeah, it might have been. So there's a couple of things. Depends on when he applied for it, because insurance companies have been relaxing some of their things. So like it might have been a denial back then. It's also if he was just diagnosed with it, likely a denial. There's a lot of things that require years of
management.
Years of management. If you can prove that you're taking medication and it works, the farther you get away from the diagnosis and you show that it's controllable, the less impact it'll have on their decisions. So that definitely makes a difference. What else might make a difference on that? So time from the diagnosis, medication showing that it can be controlled. It's possible that maybe whoever he was talking to, maybe he only works with one carrier and that carrier doesn't allow it.
Okay.
Because different carriers allow different things. Some specialize in certain conditions.
Or risk factors.
Yeah. Yep. Okay. Yep. So John Encinas, True Choice Financial. And I will send you the link afterward.
Okay.
Because this has to process. It takes a little while to process, and then I'll upload it and I'll send you the link.
Okay.
So if you haven't got it, I'll try and get it to you by tonight. If you haven't got it, just send me a quick reminder. Okay. My cell phone number is right here. You can send me a text to that number.
Okay.
Okay. That should do it. Oh, you know what? Let me look up. I don't know if I can do that on here. Let me look up John. John has a Calendly also. So if you ever need to just sign up for a meeting with him, you can just click on the link. It's in his signature though. So let me see if I can pull that up.
Do you ever get pushback from some potential clients who are skeptics to say, James, this IUL sounds great, but it sounds like it's too good to be true? What do you say to them? In regards to
that's where I just talk about my personal experience with them.
Okay.
So like, yeah, it does seem too good to be true. Like, why doesn't everybody know about this? Well, part of that is because, Wall Street is very influential. Almost everybody hears about how great it is to go out and invest in stocks, unless the market's crashing. This was the insurance company's response to everybody moving their funds over to Wall Street. It used to be that life insurance was the place people stored all of their money. And Wall Street basically took that over. And so the insurance companies had to evolve. IULs is one of those products that they came up with where they can provide the upside growth potential, but none of the downside. And it's kind of an exclusive. The only way to get that is through life insurance that I'm aware of. So I view it as a great supplement. I don't say that somebody should put all of their money into this, because you do have greater growth potential in the market, but you're also 100% at risk. So let's see, there it is. So if you need to, if you have a hard time connecting with him, you shouldn't. He's usually pretty good about responding, but you can always just snag a spot in his calendar. It's like what I always suggest to people for me, because like I get so busy, I'm basically focused on whoever's in front of me at the time. Like I have meetings all day, every day, and not much time outside of that. So if you're not getting a response, grab a meeting slot. And I've created some 10-minute meeting slots that are like phone calls, because I don't answer the phones. Everything's a spam these days, it seems like. So I basically ignore it.
Oh, I found the feature on my iPhone. It says, do not answer calls that's not in your contacts. It's been a game changer. And I was like,
Oh,
well,
yeah.
just leave a voicemail if it's really important. But I have like the daycare, the doctor, all those numbers programmed. So it'll ring. But other than that, if it's not someone I know, it'll silence it and let me know that I had an alert.
Oh, that's cool. I haven't used that. I might have to consider that. I don't put everybody in my contacts though, so I might.
Yeah, I don't know. You're the caliber, Jay. I don't know if I can do that.
Right. All right. Well, nice to meet you. Just reach out to me if you got any questions in the meantime.
Okay.
And I'm here to help.
Thank you so much. I appreciate your transparency. All the work that you do doesn't go unnoticed. I'm sure people been. I don't want to gaslight you, but it's great. I'm glad my path led parallel to you.
Thanks. Well, I hope to help.
All right. Thanks, man.
See ya.